Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 11th of October. It's been another volatile week, a number of pushes and pulls straining on the markets on both sides of the pond. Certainly in terms of the UK, it's been particularly hit by the height of energy prices and natural gas prices in particular. There are also concerns around stagflation, that is, tepid economic growth versus high inflation. More positively, in the US, there are increasing signs that economic recovery is back on track. Nonetheless, this may well result in the Fed tapering its bond asset purchasing program, with an announcement expected probably in November. And there was also some positive news on an extension to the $28 trillion debt ceiling, which should assuage the bears for now. So it's been a fairly tricky week. The US has managed to regain some of its poise, such that in the year to date, the Dow Jones is now up 13.6%, S&P 500 up 17%, Nasdaq up 13.7%, and the FTSE 100 is just about ticked higher, now up 9.7%. Turning to next week, particularly in the US, the third quarter reporting season begins in earnest, and that will be typified by a whole range of banks in the States reporting, from the likes of JP Morgan Chase, Wells Fargo, Bank of America, Citigroup, Morgan Stanley and Goldman Sachs. And in what may prove something of a read across to UK banks, which start reporting later in October, some of the things to look out for will be the fee income, because obviously there's been a spate of M&A activity, any further bad debt releases, trading profits, and indeed appetite for loans. So that will be an interesting picture of where the US economy is currently standing. In terms of next week in the UK, it's still fairly light on the corporate calendar. A couple of companies to look out for. Got a trading statement from Dunelm. Now, Dunelm shares have been beneficiaries of the pandemic, notwithstanding the fact, of course, that stores have been closed for much of that period. Over the last year, the shares are down 19%. But to put that in perspective, if you go back on a 3-year view, the shares are up 140%. When we last heard from them at their full year numbers, they did mention that there were growing digital sales to make up for some of those store closures, and they actually announced a special dividend. Revenues are up 26%, pre-tax profit was up 45%. So stores versus online is one thing to look out for, as will be any margin pressure arising from the well-publicised supply chain blockages. Also, trading statement due from Hays. We've had some very strong numbers recently from the likes of Robert Walters and Page Group, basically saying that the competition for talent is very fierce at the moment in terms of the employment market. So again, it'll very much be a case for Hays of looking out for how their performance has stacked up, and equally importantly, what their outlook is on the coming few months in the employment market. Shares have done fairly well, up around 39% over the last year. Thank you for watching. Have a great week.